When it comes to real estate investing, you might have heard the term equity multiple thrown around. But what does it actually mean, and why do investors care about it so much? Today, let's break down the concept of equity multiple and how it can help you understand the potential returns on a real estate investment. In simple terms, the equity multiple measures how much money you get back compared to what you originally invested. It's a key metric for real estate investors because it gives them a clearer picture of their total return over the life of an investment. The formula for calculating equity multiple is pretty straightforward. Your equity multiple equals the total cash received divided by the total cash invested. Let's break this down with an example. Imagine you invest $100,000 in a commercial real estate project. Over several years, you receive $200,000 back in total cash flows, including rental income and the profit from selling the property. Using this formula, the equity multiple here would be $200,000, which was your total cash received, divided by $100,000, which was your total cash invested, which equals 2.0. An equity multiple of 2.0 means you've doubled your money, getting $2 back for every $1 that you invested. The equity multiple is a simple yet powerful way to assess the profitability of an investment. It shows you the total return, but it doesn't tell you how long it took to achieve that return. For example, a 2.0 equity multiple is great, but whether you achieve that in 3 years or 10 years makes a pretty big difference. That's why investors often look to the equity multiple alongside other metrics like the internal rate of return or IRR to get a full picture of an investment's performance. Here's what different equity multiples mean. An equity multiple greater than 1.0 means you're making a profit. If it's 1.5, you've received 1.5 times your initial investment. An equity multiple that is equal to 1.0 means that you've broken even. You got back exactly what you put in. And an equity multiple less than 1.0 means you've had a loss. For instance, a 0.8 indicates you've only received 80% of your initial capital investment. The equity multiple is a quick snapshot of potential profitability, especially useful when comparing different investments. However, keep in mind that it doesn't factor in the time it takes to achieve those returns or the risks involved. That's why investors use it in combination with other financial metrics to make well-rounded decisions. So, what is an equity multiple? It's a straightforward way to measure how much return you'll get for every dollar invested in a real estate deal. While it's not the only number investors should consider, it's a key piece of the puzzle in evaluating an investment's overall potential. If you found this explanation helpful, don't forget to like and subscribe to the channel for more easy-to-understand real estate insights. Now, the equity multiple is only one piece of the puzzle. Check out these 3 methods on calculating commercial real estate investment returns.